Stocks have two jobs, and most people only hire one of them. The other one's been quietly working overtime while everyone's been too busy staring at charts to notice. We live in a world obsessed with a number going up the ticker, the portfolio screenshot, the I bought at 40 and it's now 200 story at the dinner party. But treating stocks like lottery tickets means you've completely ignored the other lever, sitting right there, dusty and underused, like a gym membership in February. Let's back up and actually build this out. Because understanding both levers isn't just smart, it's the difference between speculating and actually investing. Lever one is price appreciation. You buy a share at $50, it goes to 100, you sell, you win, simple math, dangerous psychology. Lever two is dividends companies, literally mailing you a check just for existing as a shareholder, which sounds made up, but has been happening since the 1800s. At their peak, dividends accounted for over 40% of total stock market returns across the 20th century, and yet somehow they became the boring cousin nobody invites to the conversation. Here's the metaphor that makes this click. Price appreciation is like flipping a house, exciting, risky, timing dependent, and deeply dependent on someone else valuing it more than you did. Dividends are like renting that same house out, slower, quieter, but it pays you while you sleep. And frankly, it doesn't care what mood the market is in. The historical data is almost insulting in how clear it is. $1 invested in the S&P 500 in 1960 without reinvesting. Dividends grew to roughly $17 by 2020. Reinvest those dividends, and that same dollar became over $2,000. We collectively chose the shiny lever and walked past the wealth compounding machine like it had a sign that said, boring, skip this. Now here's where the behavioral economics gets spicy. Humans are wired for narrative, and my stock doubled is a much better story than I quietly accumulated yield for 12 years. Daniel Kahneman basically built a career showing us that we overweight dramatic outcomes and underweight steady, probabilistic ones, which is exactly why dividend investing feels less exciting even when the math screams otherwise. The misconception worth dismantling right now is that dividends are only for retirees or people who've given up on growth. That's flat out wrong, and honestly, a little classist in its assumption. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have raised their dividends for over 50 consecutive years each, through recessions, pandemics, and every market panic you can name. There's also a discipline argument hiding inside dividend investing that nobody talks about loudly enough. Companies that consistently pay and grow dividends are essentially submitting to a financial lie detector test every single quarter. If the cash isn't there, the dividend gets cut, which means dividend track records are one of the most honest signals of business quality available to regular investors. The practical lesson here is boring to say, but critical to live. Don't build a portfolio around only one lever when two exist. And don't confuse excitement with edge. A diversified approach, some growth, some yield, all with position sizing that lets you survive being wrong, is not a compromise. It's the actual strategy. Conviction without sizing is just gambling with extra steps. And timing the appreciation lever has humbled professionals with Bloomberg terminals and decades of experience. Your job isn't to be right dramatically, it's to be right consistently, at a size that doesn't wreck you when the inevitable wrong call comes. Here's the philosophical close. The market doesn't reward the most excited investor or the most confident one. It rewards the most patient and the most prepared. Two levers exist for a reason, and the investor who uses both, without ego and without urgency, tends to end up in a very different place than the one chasing the next 10-bagger. Whether the market rips higher or corrects 30% tomorrow, a portfolio built on both appreciation potential and dividend income has something to say in either scenario. And that kind of structural comfort isn't luck, it's architecture. You don't have to predict the future perfectly if you've built something that works across multiple futures. And if this way of thinking, building systems, stacking income streams, making your money work in more than one direction, if that resonates with you beyond just stocks, check out the links in the description below where we can help you get started, whether in real estate investing, home contracting work, or finding lenders.